Fine. So let's start with the session. Now, in the module 3, so we are, so the subject which I am taking is the strategic performance management and business valuations, and predominantly I have been covering module 1, 2 already done, and we are on module 3. And in this module 3, typically the name of the module and especially of section A is all about economic efficiency of the firm performance analysis. And in that there are 3 aspects which were there. I have already covered economic performance indicators in one of the session. Then in the previous session I have covered already the market factors affecting pricing decision. And today I will take the third aspect, which is about profit optimization under different market structures. So let's understand in what sort of different market structures are prevailing in the economic environment, and at the same time how profit optimization can be achieved in each of the market structure. So let's begin, and it's already 6:45, so let's start. Just a second. Yeah. So to introduce with the topic, let's first understand the SWOT analysis. Obviously this I have already covered SWOT analysis per se elaborately, because it's a separate chapter altogether in the module 2, which is about strategic performance evaluation, improvement and measurement also. So we had seen in module 2 how the performance is to be measured, managed and evaluated also, and the tools in relation to the measurement and improvement also. So SWOT analysis is one of that aspect. So normally in high level management or top level management, as a management accountant, you will always observe that the top level managers use SWOT, that is strengths, weaknesses, opportunities and threats, to pursue strategic goals per se. And therefore, if you see, really the strength and weaknesses, opportunities and threats are all while classified between internal and external factors. So for SWOT analysis, we see the internal environment is dependent, or the strengths and weaknesses are internal factors, and external environment consist of opportunities and threats. So external factors always have opportunities and threats. So the organizational performance success depends on both internal capabilities and external market conditions also. Yeah. So Anu, you have just joined in. Are you able to see the PPT and hear me out also? Anu and Rakesh? Are you able to see me, not see me, see the PPT and hear me out also, Anu and Rakesh?
Yes, sir.
Perfect, great. So yeah, we just started. So this is module 3, chapter 2, profit optimization under different market structure. And in that SWOT analysis I am explaining. So obviously every organization's performance success depends on both internal capabilities and how internal capabilities are attuned with the external market conditions. So strategic performance measures external environment plays a crucial role in business success or failure, because a lot of influences are happening or happen of external factors on the internal environment of a particular organization. So superior performance is measured by profit and profit growth, which is reflected in market share. So if at all your performance is up to the mark or is superior in quality, then it can be measured by way of profit and how the profit growth is happening, and obviously this gets translated into the market share per se. So just to give an example about this market share, how important it is and how market share is a reflection of the performance of a particular business organization. In the study material itself, there is a case study or an example of Apple iPhone in India, how Apple iPhone per se in India has captured the market share from 2019 to 2021. So that's where the data points are available in the study material also. And in a way, this analysis is, or the graph that you are seeing is a graph available in our study material only. To explain that particular market share concept, so market share fluctuated between 2.65% to 3.16% from July 2019 to September 2021. So almost in a period of 3 years, there was a rise from 2.65% to 3.16%, and again it dropped to 2.73% in Jan 21 due to the shift to online education during COVID-19. So there was a decrease in 2021 due to shift to online education during COVID-19. The market and profit analysis, in a way, understanding both own product performance and competitors' market share is key to achieving strategic goals. So if you see the trend in this graph, there has been a peak somewhere in Jan 2021, and then again the downfall happened in September 2021, and thereafter again there is a peak which is happening. So to define profit, because we are talking about profit optimization under different market structures, let's define the profit. Accounting concept wise, profit means excess of revenue or expenses in a particular financial year. And the economic concept of profit is excess of closing net assets over opening net assets, capital maintenance. So overall, how much of wealth creation has happened in terms of assets. So if the closing net assets are more than the opening net assets, then economic concept wise you have earned profit. Whereas accounting concept wise, the profit definition is excess of revenue or expenses in a financial year. So now what are the profit measurement standards? So the economic profit is recognized in the conceptual framework for financial reporting under the Indian accounting standard, Ind AS what we call as, whereas capital maintenance is adopted as a standard procedure in accounting. So the profit formula is pi, that is equal to revenue minus cost. So pi is equal to Q into P minus TVC plus TFC, and we will understand what is meant by TP, what is meant by Q, what is meant by P, TVC, TFC, etc. So therefore further this thing which comes is pi is equal to revenue minus cost. Sorry, just a second. I guess there is a typing error. So let me just rectify that. So profit is equal to revenue minus cost, that is Q into P. So that's revenue. So over here Q means the quantity into price. So quantity sold into sale price minus total variable cost. So VC means variable cost per unit, and plus a total fixed cost. So that's how the profit is calculated. That's the profit formula. Now over here the component, let's understand the components of profits. So fixed cost is nothing but consider a non-operating expense in financial accounting and depends on the scale of operations. The market factors in profitability are dependent on the quantity sold, and which depends on the market conditions, and sale price is market driven, not just cost based. So traditionally the financing includes or suggests pricing as cost plus anticipated profit, but in reality competition dictates the price. So let's understand the market structure now. The definition of market will be typically a place where buyers and sellers meet to transact goods and services. It involves sale and transfer of ownership. And economic perspective wise, market means a market consisting of buyers and sellers transacting over a particular product or product category. Example, housing market, clothing market, grain market, etc. So the expert's definition of market, let's understand. Now the expert's definition of market, Philip Kotler, one of the management gurus, has defined market as a societal process where individuals and groups exchange products and services to fulfill their needs and wants. Carnot, another expert, defined market as a market is not just a physical place but a region where buyers and sellers interact freely, ensuring price uniformity for the same goods. And Gibbons defined market as a market refers to a group of people engaged in business relations and large scale transactions of a commodity. So these are the three expert definitions of market and also included in our study material, which I thought I'll cover and explain also. So broadly, if you see all the three definitions, it is nothing but a marketplace. Obviously, more of physical, and now with e-commerce coming into existence, it no more necessarily that there should be a physical marketplace, but it's a place where buyers and sellers come together, they interact freely and thereby ensure price uniformity for the same goods. So let's see the elements of market now. So the elements of market includes first and foremost transaction agreement. So the buyers and sellers agree on a price for a particular product. Then second element is the product awareness. Both parties are aware of the nature of the commodity. Both have understood the commodity equally and in the same manner. Price determination. Price is a set based on market conditions. Competition influence. So that again is a key element of market. So in competition influence, the competition increases with more buyers and sellers. In sellers market, more buyers means higher the price, so buyers are aggressive. And in buyers market, more sellers means lower the prices. So this typically market characteristics are there in any market. Communication again has to be there should be a free interaction between buyers and seller. Market size will range from a city to a global scale also. And product nature, so if it's a perfect competition is always there about the homogeneous products, and other markets has a marketplace for differentiated products. So these are the product nature which are prevailing in the market structure or are predominantly the elements of market. So in a way, the elements of market are transaction agreement, product awareness, price determination, competition influence, sellers market, buyers market, communication, market size and product nature. So let's define the market structure as such. So market structure refers to the classification of industries based on competition level for goods and services. The key factors are characteristics that influence company behavior and market outcomes. The importance of market structure is understanding market structure helps strategic goal realization. At the same time, it affects the price determination and profitability also. So let's see the classification of market structure. So on the basis of competition, normally the classification of market structure is represented as below. So there are two scenarios which are prevailing on the basis of competition. One is a perfect competition and second is the imperfect competition. Now what happens again depends in imperfect competition. There are three another types of market structures. One is a monopoly, second is a monopolistic competition and third is the oligopoly. So these are the market structures that are classified based on the competition. So if you go further, an in-depth analysis of the various market structures along with the profit maximization principle for each of them is outlined here under. So perfectly competitive market, let's understand how popularly known as perfect competition. So let's see how profit maximization as a principle looks like in a particular market structure. So in case of perfect competition or perfectly competitive market, there are many buyers and sellers that are in existence, none of whom can influence the price. So no particular set of buyers or no particular set of sellers will influence the price. Homogeneous products are sold with no differentiation. free entry and exit of the firms in the market, perfect information is available to all participants, and price is determined by market forces of demand and supply. Since no individual firm has market control, all firms are price takers, ensuring maximum efficiency in resource allocation. So that's how the perfect competition scenario should be or is in a perfect competition market or perfect competitive market. Now these are the, in a way you can say, the characteristics of a perfect competition. No buyers and sellers exist, none of whom can influence the prices. Homogeneous products prevail with no differentiation. Free entry and exit of firms in the market. Perfect information is available and price is determined by market forces of demand and supply. So prices are determined by the forces of demand and supply. Imperfectly competitive market, popularly known as imperfect competition. So over there, fewer sellers are there or buyers exist, giving some firms market power. Products are differentiated either by branding, quality or features. Barriers to entry and exit restrict the competition. Firms have control over prices rather than being price takers, and information is not perfectly available to all participants. So here in this market structure includes monopoly, oligopoly and monopolistic competition, where firms compete based on the factors other than just price. So frankly students, what I have done over here, the entire study material that is available for us as a common platform for gaining knowledge for a particular subject, I have tried to simplify, study it through and simplified it in such a fashion which will help you to write the answers also, if at all anything comes up theoretically in such kind of conceptual aspects. So if at all a short note is there about perfectly competitive market, and if these pointers are remembered by you, and if you write down these pointers in your answer, I am sure you will be able to gain as much score as possible in your examination. So keeping exam orientation in point of view, I have tried to cover the pointers in these kind of PPTs also. So these can act as a handy notes to you and reference points or reference study material during your exam preparations. So features of perfectly competitive market includes a large number of buyers and sellers. No single participant can influence the market price. Homogeneous products, where goods produced by different firms are identical. Free market and exit, free entry and exit. So firms can enter or leave the industry without any restrictions. Perfect knowledge about the prices, supply and demand. Transparency is there. Both buyers and sellers have a full, transparent and complete information about the prices, supply and demand forces also. Perfect mobility of factors of production. Resource can move freely from between the industries. No artificial restriction, no government imposed price controls or barriers affecting demand and supply. Price is determined by the market forces. So prices are set by the interaction of demand and supply. No need for advertisement. Since products are identical, homogeneous, advertising and promotions are unnecessary. So this is the perfectly competitive market features. So let's see how price determination happens under perfect competition. Large number of buyers and sellers. No single entity can influence the price. Homogeneous products. Goods are perfect substitutes for each other, ensuring uniform pricing. Perfect market knowledge. The buyers and sellers have full information about the prices and market conditions also. Uniform pricing is adopted. Prices remains the same across the market due to competition, because no one, the demand and supply forces determine the prices of a particular product. So short run profit or loss, firms may earn abnormal profits or suffer losses in the short run. Long run equilibrium, only normal profit exists as inefficient firms exit the market. Price determination is always done by demand and supply forces. Equilibrium price is set where demand equals the supply. Price is market determined through the interaction of demand and supply forces. Supply and demand relationships. So supply curve is directly proportional to price. Demand curve is inversely proportional to price. Theoretical concept: perfect competition is an ideal state of market structure, rarely found in reality. So this is in a way at times considered to be a myth also. Perfect competition normally doesn't exist in any economy because it's too idealistic. Normally that's not the way the market runs in reality. To give a classic example of market determination under price determination under market competition is the demand and supply and equilibrium. So just to explain this table, so on the left hand side the column is about price, demand, supply and how the price movement is happening. So let's say if the price of a particular product is ₹5 and the demand is 200 and 600 is the supply, then the price movement is likely to go downward because too much of supply is available and less of demand. Then so on and so forth. So if it's if the price is 4, demand is 300 and supply is 500, it's a downward price movement. So if the price is 3, demand is 400 and supply is 400, no change. So the demand and supply in a way are matching, and that typically is the scenario of equilibrium price. We'll see down below the analysis also. So if the price further drops down to 2, the demand is likely to increase to 500 and supply is likely to reduce to 300. So there is a upward price movement that is happening. And then if the price falls to 1, the demand is 600 and the supply is 200, so it's again upward price movement. So if one has to analyze the price determination over here, so excess supply, so if the price is equal to ₹5, demand is 200 units and supply is 600 units, so price decreases due to surplus supply. So a lot of supply is there and hence the price in a way is pushed downward. That's the excess supply situation. Then excess demand situation, let's understand. So if the price goes to ₹1, the demand is obviously 600 units and the supply is 200 units. So thereby price increases due to shortage. So shortage of supply is there and hence the price increases. The equilibrium price, which is the ideal situation, price is equal to ₹3, demand is 400 units, supply is 400 units. So equilibrium is achieved and the market is stable. So as a conclusion, one can conclude that the price adjusts based on the demand and supply forces. The equilibrium price is ₹3, where demand equals supply. So this is how the price determination happens in a perfect competition. Again, a graphical presentation of this similar demand, supply and the equilibrium price. So in a perfectly competitive market structure, the units of commodity supplied, that is supply curve, is directly proportional to the supply curve is directly proportional to the demand curve, is directly proportional to the price and the quantity, units of quantity demanded, that is demand curve, is inversely proportional to price. In figures above, DD, that is the demand curve, is inversely proportional to price and supply curve is directly proportional is directly proportional to the price. So this was all about perfect competition and the price determination in the perfect competition scenario. Now let's understand the imperfectly competitive market. The definition of imperfectly competitive market, or otherwise called as imperfect competition: a market that does not meet the strict criteria of a perfectly competitive market is called as a imperfectly competitive market. The real world relevance: perfect competition is a hypothetical concept and all real markets fall under the imperfect competition. So in reality, the real world situation is everything is a imperfectly competitive market, because as we saw, the perfect competition is a hypothetical concept or a ideal state, and in reality that never happens. Characteristics of imperfect competition are rather individual buyers and sellers influence the prices and production, lack of full information about products and prices, and there are high barriers to entry and exit for the firms also. So the key insight in case of imperfectly competitive market is that if even one condition of a perfect market is not met, the market is considered imperfect. So all these conditions of perfect competition, if at all any one particular aspect or element also is absent or not meeting, then it turns out to be a imperfectly competitive market. Now let's see the types of imperfectly competitive market. There are 5 types of imperfectly competitive market. One is the monopoly, second is the monopolistic competition, third is the oligopoly, fourth is monopsony, and fifth is oligopsony. Oligopsony. So that's the tricky pronunciation over here. Monopsony and oligopsony. Okay, so these are the 5 imperfectly competitive market. Now let's deep dive into each and every market now. Typically, monopoly, as we commonly know, can be defined as a market structure where one dominant seller is supplying a product or service with no close substitutes around in and around that seller. So dominant seller. So price is entirely controlled by such seller. So such seller sets the price and is not determined by the demand and supply interaction. In monopoly, because one particular dominant seller is there, there are high barriers to entry for the rest of the entrants or participants. So high barriers to entry prevents new firms from entering the market. Examples of monopoly companies in India, if one has to see, is the IRCTC. So it's a state-owned monopoly in railways, passenger and freight, both types of railways. So the rail networks are considered natural monopolies. Okay. Then the second example of a monopoly company is Hindustan Aeronautics Limited. Now this company dominates the Indian aviation and defense sector. So all aviation related transportation facilities in India as well as in defense are dominated by Hindustan Aeronautics Limited. Third category is the Cerelac. So Cerelac, which is a product of Nestle, it owns almost 96.5% market share for, or rather in baby food component or baby food segment, despite of an open market. So that's the way the monopoly has been established by Nestle for the baby food product through Cerelac as one of the product. Fourth example of a monopoly company is Coal India Limited, again a public sector company wherein it produces 82% of India's coal through private sector, though private players are now entering. So slowly the coal mines or coal industry is opening up for private sectors also. We have recently seen, so Coalgate is the word or the, there was a large hue and cry in the parliament also about Coalgate, because just like telecom scam about 2G, so 2G scam, even the bidding process was questionable in the coal industry, coal mining, and in spite of that, Coal India typically has produced 82% of India's coal, and slowly now the private players are entering into the coal sector. Fifth example of monopoly company in India is the ITC. ITC holds 77% market share in the Indian cigarette industry despite of business diversification. So ITC is no more in cigar or tobacco products. It is already there in all the kind of diverse products or diverse portfolio. However, still it holds almost 77% of the tobacco products or the cigarettes in India, in Indian industry. Yeah, so these are the examples of monopoly companies in India. Now let's see the types of monopoly that are prevailing in the economy. Neutral monopoly, geographic monopoly, technological monopoly, and government monopoly. Now let's understand one by one what is meant by natural monopoly. So natural monopoly exists when competition is unfeasible due to high financial or infrastructure cost. Just the case of Coal India. So huge infrastructure is involved and huge infrastructure cost is required to be incurred for that kind of a monopoly or that kind of a market share to be gained by Coal India. So this is a natural monopoly. Second example or second type of monopoly is the geographical monopoly. when only one business serves a specific area. For example, CESC supplies electricity to Calcutta. So, Calcutta Electric Supply Company is the sole supplier of electricity to the Calcutta. So, in a way, it's a geographic monopoly. Technological monopoly occurs when a business gets a patent or copyright for being first to market a product or services. So that's where the technological monopoly comes into existence. And fourth one is the government monopoly. Over here, government often operates as monopolies in sectors like public utilities, railways, defense and infrastructure. So a lot of PSUs in a way can be considered as government monopoly up to a particular point in time. Slowly certain industries in which government monopoly was there are opening up, and in a way opening up for private sector, or in certain industries there is a PPP model also which is adopted, which is typically called as public private partnership. So this is the model which is being used, and thereby slowly the government monopoly is being eased out in certain sectors. Now let's go to the second market structure in imperfect competition. So, or rather imperfectly competitive market. So the second type is monopolistic competition. Now what is meant by monopolistic competition? It means a market structure with many sellers offering similar but not identical products is called as monopolistic competition. The key feature over here is that there is a product differentiation. Yeah. So there is a product differentiation which makes each brand unique despite competition. So over here the price control is also there. So price control is achieved by, so businesses are the price makers, but individual pricing decisions do not significantly affect the competitors. Another characteristics of monopolistic competition example, if at all someone has to give, competition example are Pizza Hut, Domino's and Oven Story in food sector. Each offers unique menus and sets its own pricing strategies despite being in the same industry. So all these three are in the food sector only, but every brand has a unique product differentiation which makes each company a unique brand despite of the competition they face in certain products in the food sector. So each offers unique menus and sets its own pricing strategies despite being in the same industry. That is called as monopolistic competition. Then the third category is about oligopoly. So oligopoly, in a way, definition is a market structure with few sellers and many buyers. So that situation is called as oligopoly. Position over here, it lies between monopolistic competition and monopoly per se. Market power, no single firm can raise prices independently. Firms must collude to increase profits. So there has to be a joining hands of the firms to increase the profits. So product type over here, goods are usually undifferentiated, providing similar benefits. Example in India, if at all one has to give, is the automobile sector, cement, steel, aluminum industries. So in oligopoly there is a special case of duopoly. Now let's understand what is meant by duopoly. The definition of duopoly is this type of oligopoly with exactly two sellers in the market. There could be many buyers, but there are only two sellers. So let's see with the example and understand also what is meant by duopoly. So product characteristics, they are homogeneous products with no close substitutes. They are not substitute for each other, but they are homogeneous products. So example, classic example in India would be Pepsi and Coca-Cola. So in soft drinks market, these are the two duopoly which is there in soft drink market of Pepsi and Coca-Cola. Both provide homogeneous products, but they are not substitutes for each other. Another example in e-commerce industry would be Amazon and Flipkart. So both are duopoly cases. Amazon also is in e-commerce and Flipkart also is in e-commerce, but they have their own uniqueness in offerings. Another example is the Intel and AMD brand, which are the typical consumer desktop microprocessors. So both are in hardware, computer hardware industry. So Intel and AMD classically represent the duopoly structure, market structure. Then comes monopsony. So monopsony is defined as a market structure with only one buyer and multiple sellers. Over here the price control, because the buyer is only single, there is only one buyer, as what the buyer says the sellers will have to do. So buyer dictates the prices, demand and conditions for goods and services. The classic example will be for public works sector. The state government is the only buyer while multiple construction firms compare to provide provision of services. So in public works sector, the state government is the only buyer while multiple construction firms compete to provide services. So that's where the bidding comes. So the classic example is the infrastructure that happens or is done by the state government. Over here, the buyer of the services is only state government, whereas the service providers are multiple construction firms catering to the infrastructural needs. Then one more type of imperfect competitive market is the oligopsony. Oligopsony definition would be a market structure with few buyers and many sellers. So it's not single buyer, but few buyers and many sellers. So the buyer is the power, buyer has the power, buyers influence price and product characteristics due to their limited number. Example, cereal production. So many farmers produce cereals, but only a few firms purchase them. So it's a case of oligopsony. Now let's understand the price discrimination. What is meant by price discrimination? The definition, if at all one has to put across as a price discrimination, it is the selling the same product at different prices to different buyers under monopoly. So the market structure is monopoly. However, there is a discrimination between the same product pricing. So selling the same product at different prices to different buyers under monopoly. Economic definition would be selling a single controlled product at varying prices to different consumers. So typically the conditions for price discrimination involves market segmentation. The monopolist must divide the market based on the price elasticity. No resale between the markets. Buyers cannot resell from low prices to high price markets. Example of price discrimination is common in electricity, gas, medical services, transport, entertainment, where resale is impossible. So this is the characteristics or explanation of price discrimination per se. So let's understand the kinds of price discrimination. One is the personal discrimination. Over here, prices vary based on the customer's ability to pay. Example, a doctor charging higher fees to a rich patient and lower fees to a poor patient for the same service is called as personal discrimination. It's his choice to discriminate between the high net worth individual or a low net worth individual while providing his services. So he will charge high fees to the rich patient and thereby he covers up by paying lower or seeking lower fees from the lower or the poor patient for the same services. The second kind of price discrimination could be place discrimination or local discrimination. Different prices are charged based on location. Example, dumping. So selling a product at lower prices in foreign markets and higher prices in domestic market. That's a classic example of dumping, or which is called as a place or local discrimination. The trade or use discrimination. Now over here, different prices are set based on the purpose of use. Example, electricity is sold at lower rates for agricultural sector and higher rates for industries, because the kind of profit generation that is done by both sectors are different, and hence based on the use the discrimination is done in the prices. So different prices are set based on the purpose of use. So electricity is the same, product is the same, but the purpose of ultimate use is different, and hence the pricing is different for agricultural. At the same time, pricing it is different for residential purposes, and at the same time pricing is different for business purposes also. So that's how trade or use discrimination is. So in a way, the kind of price discrimination are three types: personal, place or usage or trade discrimination. Now let's understand the degrees of price discrimination that are prevailing in the various market structure. The first degree price discrimination is the perfect price discrimination. The monopolist captures the entire consumer surplus by charging each buyer the maximum price they are willing to pay. So no consumer surplus remains, because in a way the monopolist captures the entire market surplus by charging each buyer the maximum price they are willing to pay. So this is the perfect price discrimination. Now let's see the second degree of price discrimination. The monopolist captures only a part of the consumer surplus. So prices vary based on the quantity purchased or customer preferences, example bulk discounts. The third degree of price discrimination would be the monopolist provides or divides consumers into different groups based on elasticity of demand. Each group is charged a different price, and most common form of price discrimination, example student discounts, senior citizen pricing, is a classic example of third degree price discrimination. So these are the various degrees of price discrimination that are prevailing in the market structures. Now let's understand the importance of price discrimination. Why the price should be different at all? Let's understand. So the price discrimination in a way ensures profitability for essential services like railways, which might otherwise operate at a loss under uniform pricing. So same prices cannot be charged for any kind of passenger. It has to be in a differential way, and thereby the example of railways is given, which might in a way otherwise operate at a loss because of the uniform pricing. So again, price discrimination supports public welfare by allowing price adjustments based on the ability to pay. Example, doctors charging higher fees for the rich and lower for the poor is thereby achieving public welfare. So this helps businesses maximize revenue by capturing different levels of consumer willingness to pay. The third benefit of or importance of price discrimination is that it encourages accessibility. So because of price discrimination, essential goods are easily accessible for everyone, including the lower income group also. Because in a way, for lower income group, the essential goods are available at a lower price. So that's how the price discrimination in a way ensures social status or social stability. Now let's come to the concept of, we saw price, we are on the topic of price optimization under different market structures. So far we have seen the various market structures. Now let's see how profit optimization can be achieved. So what is meant by optimization? Let's understand that first. So optimization refers to the maximization or minimization depending on the objective with which the profit optimization is thought of or is seen. So firms aim to maximize profit or minimize the cost. The mathematical techniques of maxima and minima are applied to profit and cost functions for optimization. There are constraints that affect the real world optimization requiring modifications to standard techniques. Linear programming is commonly used for constraint optimization. So advanced techniques are used for profit optimization like goal programming or integer programming are applied for complex optimization problems. The optimization techniques are essential for economic decision making and resource allocation. So these are the characteristics of profit optimization or overview of profit optimization, what it means. Now let's see the optimization of functions. So optimization finds the critical points where a function reaches its relative maximum or minimum. The two key steps are followed. First order condition, which involves the first derivative of the function is set to 0. Solving this equation gives the critical points where the function could be at its maximum or minimum. The first derivative represents the slope of the function which is 0 at critical points. The second order condition, test of concavity. The second derivative is used to determine whether the function is at a maximum or minimum. If the second derivative is more than 0, the function is at a minimum, and if the second derivative is less than 0, the function is at a maximum. Conceptually, the second derivative represents the curvature of the function, confirming whether the critical point is a peak or a peak of a value. So these are the two steps that are followed for optimization of functions. Now let's see the optimization technique in economics. So the optimization in economics involves maximizing profit or minimizing cost, sometimes under constraints. So the key economic concepts include total cost is equal to sum of total variable cost, that is TVC, and total fixed cost. So the formula is TC is equal to VC into quantity plus total fixed cost. Now the other concept, key economic concept in economics or the optimization technique in economics is all about average cost. So the total cost is divided by the quantity sold. So average cost is equal to variable cost into quantity plus total fixed cost divided by the quantity. That's the formula. The third key economic concept is marginal cost, that's equal to change in total cost from producing one more unit. So the formula is MC, that is marginal cost is equal to derivative of total cost divided by derivative of quantity. So for example, if total quantity or total cost is equal to quantity raised to 2 plus 8Q plus 105, then MC or the marginal cost is equal to 2Q plus 8. Then fourth concept is the total revenue. So total revenue is the sale price P multiplied by quantity sold. So TR is equal to P into QTOR, that is P into Q. So where P is the price and Q is the quantity sold. Marginal revenue. So marginal revenue is represented by MR, change in total revenue from selling one extra unit. So MR is equal to derivative of the derivative of TR divided by derivative of Q. So for example, if TR is equal to 15Q plus 4Q raised to 3, then MR is equal to 15 plus 12Q raised to 2. Total profit pi is the difference between total revenue and total cost. So pi is equal to TR minus TC So sorry, there is a typo repetition which has happened. So the extended formula or expanded formula is equal to pi is equal to P into Q, price into quantity sold minus variable cost into quantity plus total fixed cost, that's equal to Q into bracket P minus VC minus total fixed cost. So continue with the optimization technique in economics. Optimization economics aims at either profit maximization, increasing revenue while maximizing cost, and cost minimization, which means reducing cost while maintaining required output. So optimization can be constrained or unconstrained depending on the market conditions and the business strategies that are adopted by the organization. Yeah, so profit maximization in perfectly competitive market, how it can be achieved. So let's see perfect competition overview. A perfectly competitive firm is a price taker. And can sell any amount of commodity at a prevailing market price. So though perfect competition is rarely seen in reality, it serves as a benchmark for all businesses. So short run profit maximization. Over here marginal revenue is equal to marginal cost. So MR is equal to MC approach is used. The firm's demand curve is horizontal at P is equal to MR is equal to AR, that is average revenue. So the profit maximization output, that is Q1, is determined at point E where MR is equal to MC. Profit per unit is equal to AE and total profit is represented by area AC AECB. So conditions for short run profit maximization, MR is equal to MC. The slope of MR is greater than the slope of MC. So profit scenario, if P is greater than AC, then it's a supernormal profit wiped out in the long run. If P is equal to AC, then firm breaks even, and if average variable cost is greater than P and is greater than AC, then the firm is incurring loss but continues to operate. And if P is less than average variable cost, then in a way firm shuts down. So shutdown point is P is equal to average variable cost. The firm's short run supply curve is the rising portion of the marginal cost curve above average variable cost. So that's the shutdown point. So this is the short run profit maximization. Now let's understand so we are understanding profit maximization in perfectly competitive firm. So long run profit maximization has the following characteristics. The firms enter the market if there are short run profits, increasing supply and lowering market prices. The short run supernormal profits disappear and firms break even in the long run. Third characteristic is that if the firms face short run losses, supply reduces, driving prices back up and eliminating losses. In the long run equilibrium, firms produce where P is equal to lowest average cost, ensuring efficient resource utilization. So thus the market stabilizes with zero economic profit, that is called as normal profit. So the last slide in this concept would be profit maximization in monopoly. So how profit maximization in monopoly can be achieved? Let's understand that. So the general conditions are the two key conditions for a profit maximization are marginal revenue is equal to marginal cost, and marginal revenue increase is more than the marginal cost, apply to monopoly as well. The profit maximization or profit maximizing output occurs where marginal revenue is equal to marginal cost, that is point E on the graph that is there in the study material. At this output level, price is determined on the average revenue curve. Profit per unit is equal to average earnings and is equal to break even point. Total profit is the area of AE BP. Now let's understand the differences from perfect competition. So unlike perfect competition in monopoly, P is greater than MR where MR is equal to MC. The rising MC curve above average variable cost does not represent the monopolist supply curve. In the long run, monopolists can adjust production scale and profits may persist due to barriers to the entry. So the role of price discrimination is that price discrimination helps monopolists increase total revenue and profits. This involves charging different prices for different quantities, customer classes or markets. For example, a telephone company may charge 15 cents or paisa for the first 50 calls, 10 cents for the next 100 and so on. So that's price discrimination. Key takeaways is that a monopolist produces less and charges a higher price than a perfectly competitive firm with the same cost structure. And second, that the market segmentation is based on price elasticity is a key feature of monopoly pricing strategy. So with this, in a way, we are at the end of the concept also. And just to do a recap of the what we have studied in this session. So we have seen what is meant by profit optimization, what is meant by profit. We saw how the market share of iPhone also over a period of time has behaved. Then we saw the definition of profit, what is meant by profit from accounting concept wise and economic concept wise. We saw certain profit measurement standards also. Then thereafter we went through the profit formula where pi is equal to, that is profit is equal to revenue minus cost, and revenue is equal to quantity into the price, sale price, minus cost is the total variable cost plus total fixed cost. We saw the various fixed components or the fixed cost components and the market factors in profitability. Thereafter we started with the different market structures that are there, and before that we defined the market, what is meant by market, where a place where buyers and sellers meet to transact the goods and services. Yeah, then we saw the economic perspective of the market. The market always consists of buyers and sellers transacting over a particular product or product category. We saw housing market, clothing market and a grain market as examples of economic perspective. Again, to recap, we went through various expert definitions of market. We saw how Philip Kotler, how Carnot and Givons have, who are the great time management gurus, have defined market as such. Then we understood the elements of market, which includes transaction agreement, product awareness, price discrimination, competition influence, sellers market, buyers market means what, communication should be free, then market size which ranges from city to global scale, and product nature, perfect competition and other markets also. Then we came to the market structure. So we defined market structure which referred to the classification of industries based on the competition level for goods and services. Then on the basis of competition, the classification of market between perfect competition and imperfect competition. So perfect competition was also called as perfectly competitive market, and imperfect competition was called as a imperfectly competitive market. In competition there are three subcategories: monopoly, monopolistic competition and oligopoly. In oligopoly again there is a duopoly also. We'll see that. Then we went into an in-depth analysis of various market structures along with the profit maximization principle. For each of them was outlined. We saw how, what are the key characteristics of a perfectly competitive market, popularly known as perfect competition. In such situation, in perfect competition, because there is no single individual firm which has a market control, all firms are price takers and ensure maximum efficiency in the resource allocation. Then we went through the various characteristics of imperfectly competitive market, popularly known as imperfect competition, where a few sellers and buyers exist, giving some firms market power. So in this market structure, typical three characteristics or three types are monopoly, oligopoly and monopolistic competition, where firms compete based on the prices other than just price, based on the other factors than just the price. So the various features of perfectly competitive market involved includes large number of buyers and sellers, homogeneous products, free entry and exit, perfect knowledge. So in a way, students, I am trying to recap what we have studied in this session, touching about the key highlight points only. perfect mobility of factors of production. Then we saw the no artificial restrictions are there. Price determination is done by market forces and no need for advertisement because the products are identical. Advertising and promotions are unnecessary. Thereafter, we went through the price determination aspects under the perfect competition. So, how prices get determined under the perfect competition? Obviously, there are a large number of buyers and sellers. Homogeneous products are available. Perfect market knowledge is easily available for the buyer and seller also. Uniform pricing is done and it remains constant all across the market due to competition. Short run profit loss. Firms may earn abnormal profits or suffer losses in the short run. Long run equilibrium is achieved, only normal profit exists as insufficient firms exist in the market. Then we saw the price determination is always by demand and supply. Equilibrium price is set where demand equals supply. Price is market determined through the interaction of demand and supply forces. Supply and demand relationship. So the supply curve is directly proportional to price. Demand curve is inversely proportional to the price. Of course, perfect competition is an ideal market structure and is rarely found in reality. There is no economy in the world which has a perfect competition. It's an ideal state. We went through a example wherein the demand supply and how the price equilibrium behaves and helps in determining the price under the perfect competition. So excess supply, excess demand, equilibrium price, and in a way price adjusts on demand and supply forces. The equilibrium price is 3 in this example where demand equals the supply. So we saw the graphical presentation of equilibrium price wherein in a way the relationship between demand supply curve and the equilibrium price is thrown. If in a perfectly competitive market structure, the units of commodity supplied, that is the supply curve, is directly proportional to the price, and the units of quantity demand, that is demanded, or the demand curve is inversely proportional to price. So DD is the demand curve inversely proportional to the price and supply is the supply curve directly proportional to the price. In imperfectly competitive market, we touched upon the definition and then we saw the real world relevance also. Perfect competition is hypothetical concept and all real markets fall under imperfect competition. The various characteristics of imperfect competition included individual buyers and sellers influence the prices and production. There is a lack of full information about the products and prices and there are high barriers to entry and exit for the firms. Key insight is that if even one condition of a perfect market is not met, the market turns or is considered to be imperfect. Thereafter, we saw the types of imperfectly competitive market: monopoly, monopolistic competition, and oligopoly, and monopsony and oligopsony. We went through monopoly, which is where the one dominant seller is supplying a product or service with no close substitutes. Price is controlled by the seller and not determined by the demand and supply. There are high barriers to entry for the various firms, new firms. Examples of monopoly companies in India, we saw how IRCT dominates railways. Hindustan Aeronautic Limited, that is HAL, dominates the aviation industry. Nestle Cerelac has 96.5% of market share in the baby food despite of open market. Coal India produces almost 82% of India's coal, though private players are now entering into the sector. And ITC holds 77% of market share in Indian cigarette industry despite of various business diversification. That's how monopoly companies are established in India. The types of monopoly obviously depend on the natural monopoly, geographic monopoly, technological monopoly, and government monopoly. Thereafter, we saw the monopolistic competition. So over here, a market structure with many sellers are there offering similar but not identical products. The classic example is the mobile industry. So in mobile industry, there is the mobile industry or mobile market is a monopolistic competition market. So there are many sellers offering similar but not identical products. The key feature product differentiation makes each brand unique despite of competition. So everyone has a space. So in telecom or rather mobile industry, Product differentiation makes each brand unique despite of the competition. The price control, businesses are price makers, but individual pricing decisions do not significantly affect competition. So even if a particular mobile company increases their price, that not necessarily impacts the other price makers. So classic example is about Pizza Hut, Domino's and Oven Story in the food sector. Each offers unique menus and sets its own pricing strategies despite being in the same industry. Then we saw the oligopoly as a another category or another kind of imperfectly competitive market or imperfect competition. We went through the definition where there are few sellers and many buyers. The position lies between monopolistic competition and monopoly. Market power, no single firm can raise prices independently. Firms must collude to increase the profits. So the product type in such market is the goods are usually undifferentiated, providing similar benefits. Examples we saw: automobile, cement, steel, aluminum industries. There is there is a special case of oligopoly also, which is called as duopoly. So over here there are exactly two sellers. So homogeneous products with no close substitutes. For example, Pepsi and Coca-Cola, both are a classic example of duopoly in the soft drinks market. Similarly, in e-commerce market or industry also, Amazon and Flipkart are the duopoly cases. And in consumer desktop microprocessors, Intel and AMD are the two duopoly cases. Then we saw monopoly, which is a market structure with one buyer and multiple sellers. So the buyer dictates prices, demand and conditions for goods and services. Typically, the classic example is that the state government is the only buyer while multiple construction firms compete to provide services. We saw public work sector means the infrastructure sector. So oligopoly is definition is a market structure with few buyers and many sellers. So buyer influence the prices and product characteristics due to their limited number. So classic example is the cereal production. Many farmers produce cereals, but only a few firms purchase them. Then we went into went through the price discrimination as such. So selling the same product at different prices to different buyers under monopoly. So conditions of price discrimination were market segmentation, no resale between the markets, and examples of price discrimination is common in electricity, gas, medical services, transport and entertainment where resale is impossible. Kinds of price discrimination that prevail in market structures are personal discrimination. So example is a doctor charging higher fees to a rich patient and lower fees to a poor patient for the same services. Place discrimination or local discrimination is different prices are charged based on the location. Dumping, so selling a product at a lower prices in foreign markets and higher prices in domestic markets. So trade or use discrimination, typically based on the usage the discrimination of pricing is done. So different prices are set based on the purpose of use. Example, electricity is sold at lower rates for agricultural purposes and at higher rates for the industry purposes. The degrees of price discrimination, there are 3 degrees. First degree price discrimination is perfect price discrimination, where monopolist captures the entire consumer surplus by charging each buyer the maximum price they are willing to pay. No consumer surplus remains. The second degree price discrimination involves monopolist or the monopolist captures only a part of the consumer surplus. Prices vary based on the quantity purchased or consumer preferences. Example, bulk discounts. And the third degree price discrimination is the monopolist divides consumers into different groups based on the elasticity of demand. Each group is charged at a different price. Most common form of price discrimination. Example, student discounts and senior citizen pricing. So the importance of price discrimination, let's understand. The importance of price discrimination we understood was that it ensures profitability for essential services like railways. It supports public welfare by allowing price adjustment based on the ability to pay, and encourages accessibility to essential goods and services for lower income groups. Thereafter we went through the profit optimization. Profit optimization refers to maximization or minimization depending on the objective. Firms aim to maximum profits or minimize the cost. These are the two aims of any business organization. There are mathematical techniques of maxima and minima which are applied to profit and cost functions for optimization. Constraints affect the real world optimization requiring modifications to standard techniques. Linear programming is commonly used for constraint optimization. Advanced techniques like goal programming and integer programming are applied for complex or optimization problems. Then we went through optimization of functions, wherein there are first order conditions and there are second order conditions, typically the test of concavity. Then we saw through the optimization technique in economics, wherein total cost, average cost, marginal cost, total revenue, marginal revenue and total profit, how they are calculated are explained. Optimization in economics aims at either profit maximization, that is increasing revenue while minimizing cost, or cost minimization, which is reducing cost while maintaining the required output. Then we saw the maximization, profit maximization in perfectly competitive firm. So perfect competition overview we saw, then the short run profit maximization and long run profit maximization. So profit maximization in monopoly also we saw the general conditions that are prevailing in profit maximization in monopoly. Then the differences from perfect competition, then the role of price discrimination, and the final key takeaways were that a monopolist produces less and charges a higher price than a perfectly competitive firm with the same cost structure, and that the market segmentation is based on price elasticity is a key feature of monopoly pricing strategy. So with this, in a way, we come to an end of the module 3 also, or rather the chapter or the last chapter or the third chapter in module 3, which was about profit optimization in different market structures. So Anu and Rakesh, do you have any doubts, queries, or you want to add to anything that we studied or we heard through during the session? You can share. Anu, Rakesh?
Yes, no question.
Nothing? All clear? Rakesh, anything that you have or anything to say? If nothing, then we can stop. Maybe we can stop the session. I am done for this session. And in a way, with this session, we conclude the module 3 also. So far, after having concluded, so let's see how much percentage of portion that we have completed by now. Yeah. So in section A for this paper 20A, which is about strategic performance management and business valuation, section A had 4 modules. So out of 4 modules, 3 modules have been completed. So first we completed is the introduction to performance management, which was like almost 10% weightage. Then performance measurement, evaluation and improvement tools, which is almost like 15% of the weightage. And third, today we are concluding economic efficiency of the firm, especially the performance analysis, which is like almost 10% of weightage. So 10 plus 15 plus 10, that is almost 35% of weightage to the entire paper has been completed today. Now the fourth module, which is about enterprise risk management, will be taken up tomorrow. So those who have joined me right now, just keep it in mind that tomorrow I have a session from same time 6:30 to 8:30. So normally Lalita ma'am takes this session, but because she has some engagement, she has asked me to take tomorrow's session and she will be taking my Thursday session. So that's a slight change or swapping that is happening between the two of us. So see you tomorrow for the session, and I'll be taking and starting up with the module 4, which is about enterprise risk management, which comprises of 15% of the weightage of the topic. So with this, we'll stop for the day and see you in the next session for the module 4. Thanks. Thanks, Rakesh. Bye.